Listen, what I'm about to tell you is going to shake your understanding of the global economy. While you were sleeping, the second largest economy on Earth just made a move that screams desperation. When China panics, the whole world should pay attention. Smash that like button, hit subscribe, because what's happening in China's property market isn't just their problem anymore. China just extended a major home tax break. Before you think this is good news, let me tell you why the Chinese government is terrified. This is a desperate attempt to stop a financial avalanche building for over 4 years. On December 30th, 2025, China's Ministry of Finance announced they're extending a policy that scraps value-added tax on certain home sales. If you're selling a home owned for at least 2 years, you pay 0% tax. 0. Selling within 2 years, they slashed the tax from 5% to 3%. Sounds generous? Wrong. Pure panic mode. Let me paint you a picture of what's really happening on the ground in China right now. Imagine waking up one day and realizing that your house, the biggest investment of your life, the thing you poured your life savings into, is now worth 30% less than what you paid for it. That's not a hypothetical scenario for millions of Chinese families. That's their reality right now, today, as I'm speaking to you. Home prices across China have collapsed by 20% or more since their peak back in 2021. In some smaller cities and suburbs, we're talking about 50% drops. 50%. Your home cut in half. But here's where it gets absolutely insane. New home sales in the first 11 months of 2025 dropped by 11.2% compared to the previous year. Property investments? Down nearly 16% from a year earlier. And folks, this isn't some minor correction. This is the 4th consecutive year of decline. For years, the Chinese property market, which used to account for nearly 30% of China's entire economy, is in a complete death spiral. Now, you might be asking yourself, why should I care about what's happening in China? Great question. Let me tell you why this matters to you. Sitting wherever you are right now, China is the world's second largest economy. When China catches a cold, the global economy gets pneumonia. We're talking about a country that's been the engine of global growth for decades. And that engine, it's sputtering, coughing, and threatening to die completely. Let's talk about Evergrande for a second, because this is where the story gets really wild. Evergrande was once the world's most valuable real estate company. Let that sink in. The most valuable. In 2018, they were on top of the world. By 2021, they defaulted on their debt. And we're not talking about a little debt here. We're talking about over $300 billion. That's billion with a B. $300 billion of debt. In January 2024, a Hong Kong court ordered Evergrande to be liquidated. The company was so deeply in debt, so catastrophically mismanaged, that there was no way to save it. And then, in August 2025, Evergrande was delisted from the Hong Kong Stock Exchange. Poof. Gone. A company that was once worth over $51 billion at its peak. Trading was suspended, and its market value had fallen to just above $275 million. From $51 billion to $275 million. That's a 99.5% collapse. But wait, it gets worse. Way worse. Evergrande wasn't just cooking the books a little bit. Oh no. The China Securities Regulatory Commission found that Evergrande had overstated its revenue in 2019 by 214 billion yuan. That's nearly 30 billion US dollars, or about half of what they claimed. In 2020, they overstated revenue by nearly 80%. We're talking 350 billion yuan, or $48.6 billion. Combined, that's $78 billion of fake revenue. They were literally marking apartments as ready to occupy when the land was still vacant. This allowed them to issue bonds, take on more debt, and it all contributed to their catastrophic collapse. Now here's the kicker. PricewaterhouseCoopers, one of the biggest accounting firms in the world, was fined $62 million for approving Evergrande's fraudulent financial statements. In September 2024, Chinese regulators banned PwC from working in China for 6 months and fined them over 400 million yuan. Even the auditors were complicit in this disaster. And Evergrande wasn't alone. Country Garden, another massive developer, has been fighting off liquidation. Vanke, once considered one of the most stable developers in China, the last man standing, is now on the brink of collapse. Let me tell you about Vanke because this is happening right now, as we speak. Vanke narrowly avoided defaulting on a 2 billion yuan bond. That's $284 million, just last month in December. They literally got a last-minute reprieve from creditors who extended the grace period. But here's the scary part. Vanke has about 60 billion yuan. That's $8 billion in cash. Sounds like a lot, right? Wrong. They have 151 billion yuan in short-term debts. That's $21 billion they need to pay back soon. They're $8 billion short of covering even half of their immediate obligations. And get this, Vanke's biggest shareholder, Shenzhen Metro Group, which is state-owned, has been propping them up with over 29 billion yuan in loans this year alone. But in November, Shenzhen Metro said enough is enough. They capped further financial assistance, saying that continued guarantees exceeded their risk tolerance and that, and I quote, blood transfusions are not sustainable. Even the government-backed entities are pulling the plug. If Vanke falls, and folks, it's looking more and more likely every single day, we're talking about a company with $50 billion in interest-bearing liabilities going down. This would be one of the biggest corporate defaults in Chinese history. And here's why that's absolutely terrifying. Vanke was supposed to be safe. It was backed by state-owned enterprises. It was on the government's list of high-quality developers in 2023. If Vanke can't survive, what does that say about every other developer in China? Let me break down what caused all of this. Back in 2020, Chinese regulators tried to cool down the overheated property market by implementing something called the Three Red Lines policy. This policy capped developers' debt-to-cash ratios, debt-to-assets ratios, and debt-to-equity ratios. The goal was to prevent developers from taking on too much debt. Makes sense, right? Stop companies from over-leveraging themselves. But here's the problem. It backfired spectacularly. Instead of gradually cooling the market, it triggered a full-blown liquidity crisis. Developers who had built their entire business models on cheap debt suddenly couldn't borrow anymore. Projects stalled. Sales collapsed. Prices started falling. And the whole house of cards came tumbling down. Now, here's where it gets even more interesting. Local governments in China had become addicted to revenue from selling land use rights to developers. This was a huge part of their income. When the property market crashed, local government revenues collapsed too. They're now struggling with massive hidden debts, unable to invest in infrastructure, unable to provide services. It's a cascading failure across multiple levels of the Chinese economy. And the human cost? Absolutely devastating. Hundreds of thousands of Chinese families paid in advance for apartments that were never completed. Imagine that. You save for years. You put down a deposit on your dream home, and then the developer goes bankrupt. Your money? Gone. Your apartment? An unfinished concrete shell. And you're still on the hook for the mortgage. This has happened to hundreds of thousands of people. The social unrest potential here is enormous. Millions of jobs have been lost. Construction workers, architects, real estate agents, furniture makers, appliance companies, everyone connected to the property supply chain has been hammered. The unemployment rate crept up to 5.2% in 2025, and that's just the official number. The real unemployment, especially among young people, is likely much higher. Now, back to this tax break extension. The Chinese government is throwing everything at the wall to see what sticks. They've cut mortgage rates. They've lowered down payment requirements. They've relaxed purchase restrictions. Beijing even eased rules for non-local buyers, reducing the number of years they need to have paid taxes or Social Security before they can buy a home. They're allowing families with multiple children to purchase additional properties. They're doing everything possible to stimulate demand. But here's the brutal truth. None of it is working. People in China are terrified. Consumer confidence is in the toilet. Why would you buy a house when prices have been falling for 4 straight years? Why would you buy when you see developers going bankrupt left and right? Why would you invest in property when there's no bottom in sight? You wouldn't. And Chinese consumers aren't stupid. They're holding on to their cash, waiting for the market to stabilize. But the longer they wait, the worse it gets. It's a vicious cycle. The government knows this. That's why they're extending this tax break. They're trying to incentivize people to sell their properties, to unlock some of that frozen capital, to get transactions moving again. But reducing a tax from 5% to 3% isn't going to make someone sell their house if they think it's going to be worth even less next month. It's a band-aid on a gunshot wound. Let's talk about what this means for the global economy, because this is where it gets really scary for all of us. China has been the world's factory for decades. They manufacture everything. Your phone, your computer, your clothes, your toys, everything. When Chinese domestic demand collapses, Chinese companies start looking overseas to dump their excess production. They sell products at below-market rates just to move inventory. This creates what economists call exported deflation. What does that mean for you? It means prices might drop, which sounds good at first. But it also means companies in the US, in Europe, everywhere, have to compete with these artificially low Chinese prices. They can't compete. They close down. Jobs are lost. Wages stagnate. Economies slow down. It's a race to the bottom, and nobody wins except maybe the consumers who get cheap stuff for a little while before they lose their jobs. China's economy grew at its slowest pace in 3 years in the final quarter of 2025, just 4.5%. For context, China used to grow at 7, 8, even 10% annually. For 0.5%, that's a disaster by Chinese standards. And real estate, the sector that drove so much of that growth, is now dragging the entire economy down. Fixed asset investment in China declined 3.8% in 2025 to 48.52 trillion yuan. That's the first annual decline in decades. Decades. Think about that. For the first time in generations, Chinese investment is actually shrinking. Property investment specifically plummeted 17.2% last year. Residential sales dropped to 7.3 trillion yuan, the lowest level since 2015. Existing apartment prices just keep falling, month after month after month. Now, some analysts are saying we've already absorbed most of the impact, that the worst is behind us. And maybe that's true. But I'm not convinced. Not when Vanke is still teetering on the edge. Not when new home sales are still falling. Not when consumer confidence is still at rock bottom. Not when the government is still scrambling to implement new policies every few weeks. Here's what really worries me. This crisis has exposed fundamental weaknesses in China's economic model. For decades, China grew by investing in infrastructure and real estate. Build more cities, more apartments, more factories. But now, there's overcapacity everywhere. Ghost cities with empty apartments. Infrastructure projects that don't generate returns. A population that's starting to shrink. The old growth model is broken, and China hasn't figured out the new one yet. President Xi Jinping talks about building a strong domestic market, about shifting from investment-driven growth to consumption-driven growth. That sounds great in theory. But how do you get people to consume when their biggest asset, their home, is losing value? When they're worried about losing their jobs? When they don't trust the financial system anymore? You can't just flip a switch and change an economy that's been built one way for 40 years. And let's be honest about something else. The Chinese government's credibility is on the line here. They let Evergrande fail. They're letting other developers fail. But if Vanke fails, if a state-backed company goes down, that sends a very different message. It says the government either can't or won't save everyone. And in a system where implicit government guarantees have been a cornerstone of how things work, that's absolutely earth-shattering. There's also a political dimension here that we can't ignore. Real estate wealth was how the Chinese middle class accumulated savings. It was their pension plan, their retirement fund, their kids' college fund, all rolled into one. When that wealth evaporates, when people feel 30% poorer overnight, the social contract starts to fray. People get angry. They start asking questions. Why did this happen? Who's responsible? Why isn't the government doing more? In a country where the government controls so much, when things go this badly wrong, people look to the government for answers and solutions. The tax break extension, the mortgage rate cuts, the relaxed purchase restrictions, all of these measures, they're not just economic policy. They're attempts at social stability. The government is terrified of unrest. They're terrified of millions of angry homeowners taking to the streets. They're throwing money at the problem, trying to show they're doing something, anything, to help. But here's the thing about real estate crashes. They take time to resolve. The U.S. housing crash in 2008. It took years for the market to recover. Japan's real estate bubble burst in the 90s, and they still haven't fully recovered 30 years later. 30 years. China's property bubble was even bigger than these. The adjustment period could be long and painful. Some economists estimate that China's property market will continue to drag on GDP growth for years to come. Instead of adding to growth, it's subtracting from it. One analyst estimated it's taking about 1.5 percentage points off GDP in 2025. That might not sound like much, but when you're talking about a $14 trillion economy, that's hundreds of billions of dollars of lost economic activity every single year. So when you see headlines about China extending a home tax break, understand what's really happening. This isn't confidence. This is desperation. This is a government that knows it's sitting on a powder keg and is frantically trying to prevent it from exploding. The Chinese property crisis isn't over. It's not even close to over. We're probably somewhere in the middle innings of this disaster. What happens next? Nobody knows for sure. Best case scenario? China manages a slow, controlled deflation of the property bubble. Prices stabilize at lower levels. Demand gradually returns. The economy adjusts to a new normal with less reliance on real estate. It's painful but manageable. Worst case scenario. The whole thing spirals out of control. More major developers collapse. Banks start failing. The government has to step in with massive bailouts. Social unrest erupts. The economy crashes hard, dragging the global economy down with it. We're talking about a potential global recession. Most likely, something in between. A long, grinding adjustment period with fits and starts. Some quarters look better, giving false hope. Then another developer fails, and confidence crashes again. This could go on for years. The Japanese experience suggests it could be a decade or more before things truly normalize. And the ripple effects are going to be felt around the world. So yeah, when China panics over their real estate crisis, when they extend major tax breaks in a desperate attempt to stop the bleeding, you should be paying attention. Because what happens in China doesn't stay in China. Not anymore. Not in our interconnected global economy. If you found this video valuable, do me a favor. Hit that like button. Subscribe to the channel. Share this with someone who needs to understand what's really happening in the global economy. Drop a comment below. Let me know what you think. Are you worried about the Chinese property crisis? Do you think it'll spread globally? What do you think happens next? And remember, knowledge is power. Understanding what's happening in the global economy helps you make better decisions. Whether that's about your investments, your career, your business, whatever. Being informed is always better than being in the dark. So stay curious, stay skeptical, ask questions, and keep learning. Because the world is changing fast, and if you're not paying attention, you're going to get left behind. Thanks for watching. I'll see you in the next one.